She was standing at the mailbox when she saw it. Not the IRS envelope. Not yet. The electric bill. $41 more than last month. Carol noticed because Carol notices everything now. She has to. She is 67 years old. She is standing in the driveway of a house in Clearwater, Florida that she and her husband Dennis paid off in 2019. And Dennis has been gone for 11 weeks. 11 weeks. He went in for a routine stress test on a Wednesday afternoon in February. He never came home. 39 years of marriage, 2 kids, 4 grandchildren, a traditional IRA they built together over 4 decades of careful, deliberate, disciplined saving. Dennis drove a used Silverado. Carol clipped coupons until 2018. They took one real vacation, Yellowstone, in 2011. They did everything right. Carol sets the electric bill on the kitchen counter next to a manila folder. The folder is from their CPA. She has read the letter inside 4 times. She will read it a 5th time tonight after the grandkids leave. Because what the CPA is telling her, in careful, polite, professionally distanced language, is that the federal government of the United States is about to extract somewhere between $60,000 and $80,000 from her retirement accounts this year. Not because her income went up. Her income went down. She lost Dennis's Social Security check. She lost half his pension. She is poorer than she was 11 weeks ago. She is grieving. She is alone. And her federal tax bill just quadrupled. That is the widow's tax penalty. And it is not a glitch. It is not bad luck. It is not a clerical error at the IRS. It is a mathematical guillotine built into the tax code. And it drops the moment the funeral home pulls away from your driveway. The widow's tax penalty silently destroys the financial survival of over 800,000 Americans every single year. And the IRS designed every mechanism of it on purpose. Let me show you exactly what happened to Carol. Line by line. Dollar by dollar, statute by statute. In 2025, Carol and Dennis filed married filing jointly. Their combined income looked like this. Dennis's Social Security, $3,600 a month. Carol's Social Security, $2,100 a month. Combined annual Social Security, $57,600. Dennis had a defined benefit pension from his employer paying $22,000 per year. They had a traditional IRA, mostly Dennis's old 401k rollovers, with a balance of $780,000. His required minimum distribution that year was approximately $29,000. They had a taxable brokerage account at Fidelity, generating about $5,000 in qualified dividends annually, and 3 CDs at their local credit union generating $4,200 in interest. Added up, $57,600 in Social Security, $22,000 in pension, $29,000 in RMD, $5,000 in dividends, $4,200 in CD interest. That is $117,800 of gross income as a married couple in 2025. Now watch the tax math. Married filing jointly in 2025. Standard deduction, approximately $30,000. Additional age 65 plus deduction, roughly $3,200. Senior bonus deduction, $6,000. Taxable income drops to approximately $78,600. The 12% federal bracket for a married couple stretches all the way to roughly $97,000 of taxable income. Dennis and Carol paid 10% on the first chunk, 12% on the rest. Total federal tax bill, approximately $8,900 on $117,000 of gross income. Effective rate, about 7.5%. 7.5%. Now Dennis dies in February of 2026. Carol is a single filer for the entire 2026 tax year because the IRS uses your filing status as of December 31st. There is a grace period called qualifying surviving spouse, but it only applies if you have a dependent child living in the home. Carol's children are 43 and 40. They have their own mortgages. Carol gets 0 grace period. 0. She files single in 2026. Here is her income for 2026. She loses Dennis's Social Security. Household Social Security drops from $57,600 to $25,200. Dennis's pension had a 50% survivor benefit. The $22,000 becomes $11,000. The traditional IRA still has a balance around $760,000. Her RMD as surviving spouse, approximately $28,700. The brokerage still throws off $5,000 in dividends. The CDs still pay $4,200. Add it up. $25,200 plus $11,000 plus $28,700 plus $5,000 plus $4,200. That is $74,100 of gross income. Carol's gross income dropped by $43,700. She lost more than a third of the household income. She is significantly poorer than she was when Dennis was alive. Now watch what the IRS does next. As a single filer in 2026, standard deduction, approximately $15,750. Age 65 plus add-on for single filer, roughly $2,000. Senior bonus deduction, $6,000. Taxable income is now approximately $50,350. Here is the blade. The 22% bracket for a single filer in 2026 begins at $48,475. Carol's taxable income is $50,350. She has crossed the 22% line. She is now paying 22% on every dollar between $48,475 and $50,350. Her base federal tax comes to approximately $7,400. But we are not finished. Not even close, because here is where the second blade drops. The provisional income threshold for Social Security taxation. For a single filer, $25,000. For a married couple, $32,000. The IRS gave married couples $7,000 more in protection. The moment Dennis died, that protection was cut away. Carol's provisional income, her adjusted gross income plus 50% of her Social Security benefits, now sits well above the $34,000 threshold for maximum Social Security taxation. 85% of her Social Security benefits are now fully taxable as ordinary income. That is $21,420 of Social Security that was partially shielded last year, now fully exposed to the tax machine. And then Irma arrives. The income-related monthly adjustment amount, the Medicare premium surcharge. While Dennis was alive, their joint income kept them comfortably under the IRMA threshold for married couples. They paid the standard Part B premium. After Dennis dies, Carol is now measured against the single filer IRMA threshold. The first IRMA tier for a single filer kicks in around $91,000 of modified adjusted gross income in 2026. Carol's Magi, including the full RMD and the now mostly taxable Social Security, pushes her toward that first bracket. Her Medicare Part B premium jumps from approximately $185 a month to $262 a month. Her Part D drug plan picks up a surcharge. That is over $900 a year, every year, for the rest of her life, because she committed the crime of being widowed. Layer the federal tax, layer the Social Security inclusion, layer the IRMA surcharge, layer the loss of Dennis's income. Carol, who paid an effective federal rate of 7.5% last year, is now looking at an effective tax burden approaching 4 times what she paid as a couple, on less money. That is not a glitch. That is not bad luck. This should make you absolutely furious. That is the tax code working exactly the way it was written. Under Internal Revenue Code Section 1, the rate schedule, and the Social Security taxation provisions of IRC Section 86, which were written in 1983 and have never once been adjusted for inflation. Never, once, in over 40 years. That is not an oversight. That is engineering. Stop right here. Tell me in the comments, have you and your spouse ever sat down and modeled what your taxes look like the year after one of you dies? Drop your state, your approximate IRA balance, and whether you have a pension survivor benefit. I read every single one. Who designed this? Who sat in a room and decided that the most efficient way to extract generational wealth from the American middle class was to wait until one spouse died and then change the tax math so violently that the surviving spouse would not have the cognitive bandwidth to fight back? Let me tell you exactly who. The Joint Committee on Taxation has documented the widow's tax penalty since the 1980s. Brookings has published white papers on it. The American Enterprise Institute has written about it. Academic economists have named it, quantified it, and presented remedies for it in formal testimony before Congress. The information has been sitting in plain sight for 4 decades. Every Congress that has had the opportunity to fix it has chosen, deliberately, not to. Why? Because the widow's tax penalty is one of the largest sources of stealth revenue in the entire federal tax structure. There are approximately 800,000 new widows and widowers in the United States every single year. The average financial profile of a 65-plus widow includes a traditional IRA balance somewhere between $250,000 and $1.5 million. The marginal tax rate jump from the bracket collapse alone, multiplied across that population, generates billions of dollars annually in incremental federal revenue. The IRS calls this revenue. Quotable. You and I call it confiscation from the grieving. The bracket structure itself is the weapon. Look at the 22% bracket. For a married couple, it stretches from approximately $97,000 to $206,000 of taxable income. That is $109,000 of bracket width. For a single filer, the 22% bracket runs from $48,475 to $103,350, approximately $55,000 of bracket width. The single filer bracket is mathematically half the width of the married filing jointly bracket at almost every level of the rate schedule. This is true at the 24% line. It is true at the 32% line. The entire architecture of the federal rate schedule was built for couples, and the second one of them dies, the survivor falls through a trap door that was engineered into the floor. Congress knew. Congress knows. Congress has chosen the revenue. Send this to one married person you care about right now, not tomorrow, right now. One conversation tonight, before anything happens, is worth $60,000 to the spouse who survives. Here are the 4 legal moves that mathematically defang the widow's penalty, before the funeral, not after. Move 1. Roth conversions. Aggressive, multi-year, planned. This is the single most important tax move in the entire pre-death planning playbook. Here is why it works. While both spouses are alive and filing married jointly, you can fill the 22% bracket all the way to approximately $206,000 of taxable income. That is an enormous conversion runway. You convert chunks from your traditional IRA to a Roth IRA each year. You pay the tax now, at the known married rate, on a known amount, in a year you choose. That money becomes permanently tax-free. No RMDs ever, no tax on growth, no tax on withdrawal, and when one spouse dies, the survivor inherits a Roth IRA that generates 0 taxable income, 0 IRMA exposure, 0 Social Security cascade. The math on Carol's situation. If she and Dennis had converted aggressively over 6 years before his death, paying tax at the 12 and 22% married brackets, the total conversion tax paid would have been approximately $90,000 to $110,000 depending on timing. The lifetime tax saved on the surviving spouse side. Conservatively, $160,000 to $220,000. The Roth conversion is the legal escape hatch the IRS put inside the same code that contains the trap. Use Form 8606 to track your Roth conversion basis. File it every year you convert. This is your legal documentation. Do not skip it. In Florida, no state income tax. Conversion math is straightforward. Every dollar converted avoids future federal bracket exposure. In Ohio, state income tax runs approximately 3 to 4% at this income level. Add that cost to your conversion calculation. Still mathematically favorable in most scenarios. In California, state income tax at 9.3% on top of federal. The conversion math requires more precision. Work with a CPA who understands California's treatment of Roth conversions before executing. Move 2. Brokerage account titling for maximum step-up. Under Internal Revenue Code Section 1014, when a spouse dies and leaves appreciated assets to the survivor, the cost basis of those assets resets to fair market value on the date of death. The embedded capital gain disappears, forgiven by statute. But this only works if the asset is owned correctly at the time of death. In a joint tenancy with rights of survivorship account, in a non-community property state, only 50% of the account receives the step-up. The other 50% retains the original cost basis. Florida is not a community property state. Ohio is not. Most states are not. If you live in a non-community property state, talk to an estate planning attorney about joint revocable trust structures that incorporate community property language, or investigate whether your state offers tenancy by the entirety treatment for appreciated brokerage assets. In California, a community property state, jointly held community property receives a 100% step-up on both halves. Confirm your account is titled as community property with rights of survivorship. That single designation could eliminate a six-figure capital gains tax bill for the surviving spouse. Move 3. Pension election, the survivor benefit decision. Most pension plans by default offer a single life annuity. Higher monthly payment while the retiree is alive, 0 after death. The joint and survivor option pays a reduced monthly amount, but continues at 50, 75, or 100% to the surviving spouse for life. Under ERISA, the Employee Retirement Income Security Act, a qualified plan must obtain the non-retiring spouse's notarized written consent before electing single life. Most spouses sign that waiver without understanding what they are surrendering. If you are already retired and locked into a single life election, you cannot reverse it, but you can execute a pension maximization strategy. The pensioner takes the higher single life payment, uses a portion of the differential to fund a guaranteed universal life insurance policy. When the pensioner dies, the surviving spouse receives an income tax-free death benefit under IRC Section 101A. That benefit can fund an immediate annuity or be invested. The replacement income stream carries zero bracket exposure, zero IRMA impact, zero RMD. Move 4. Restructure CD and bond interest before the bracket collapse. High-yield CDs and taxable bonds generate ordinary income reported on Form 1099 INT every year. That income is buried inside the wide married filing jointly brackets while both spouses are alive. The day one spouse dies, the same interest stream gets pushed into the narrower single brackets and may push the survivor across an IRMA tier. 3 restructuring options. 1. Replace high-yield CDs with in-state municipal bonds. Interest from in-state municipal bonds is exempt from federal income tax under IRC Section 103 and exempt from your state income tax. In California, a high-bracket retiree can achieve an effective taxable equivalent yield of 6 to 7% from California-issued munis. 2. Shift cash into a multi-year guaranteed annuity, MYGA. Interest accrues inside the wrapper, does not appear on your 1099 annually. The surviving spouse can access it strategically in lower income years. 3. Fund a properly structured cash value life insurance policy. Growth inside the policy is tax-deferred. Withdrawals up to basis are tax-free. Death benefit pays income tax-free under IRC Section 101A. Do this before the funeral, not after. After, the window is closed. The window to execute these moves is narrower than you think. Roth conversions take 5 to 7 years of phased execution to avoid spiking your own brackets and triggering current year IRMA surcharges. Pension elections are locked the moment you begin drawing. Life insurance underwriting requires both spouses to be relatively healthy. Once a diagnosis arrives, half these tools are gone. Trust restructuring requires both spouses to have legal capacity to sign documents. The IRS is counting on you to wait. The IRS is counting on you to assume that your standard joint brokerage account and your default single life pension will somehow protect your spouse. They will not. Carol is sitting at that kitchen counter right now, in Clearwater, reading that CPA letter for the 5th time. The electric bill is still on the counter. The manila folder is open, and everything she needed to prevent this, every legal tool, every statutory escape hatch, every Roth conversion and pension election and brokerage titling decision, was available to her and Dennis 3 years ago, 5 years ago, 7 years ago. The trap was set. The tools were available. The calendar ran out first. Do not let the calendar run out first. The IRS is patient. The IRS is waiting. The IRS has built this trap and sat back, knowing that in this country, 800,000 new widows will fall into it this year alone. You do not have to be one of them. Your spouse does not have to be one of them. The tools exist. The tax code, ironically, contains the escape hatches inside the same chapters that contain the trap. You just have to use them before the funeral. Before you go, one question. Have you ever asked your CPA to model your tax bill as a surviving single filer? Drop your answer below, yes, no, or never thought about it. Subscribe and hit the bell, because the next video covers the Medicaid 5-year look-back trap and what it does to the family home after the nursing home bill arrives. That one is even more important than what we covered today.